Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. So the big question that's going on right now is, are we going through stagflation like we did in the 70s? So we're going to get into that, and I'm going to discuss some of the key differences between back then and today. And then of course, as always, we're going to get into our outlook and what that means to your portfolio. So let's get started. All right, as always, we like to get started with the asset class returns for the month of May. Here you see the green, it shows all the year to date, and the blue shows all the 1 month to date. And so, of course, that's May. And so the green looks pretty good across the board. We're just seeing real estate and the higher quality bonds that are down a little bit for the year, especially real estate. They've really been down for the last 12, 18 months or so. And we're seeing, again, the market led by large cap tech stocks. You're seeing over here in the large cap. A lot of this is the AI. I don't need to tell you that that's been on the news everywhere. And NVIDIA, one of the big chip makers that makes a lot of these AI chips, has just been going through the roof. And so that's been driving a lot of the market lately. But it was nice to see an expansion, a little bit of the market breadth. We saw small caps doing better, had a good return, actually beat large cap. Real estate come back a little bit, and international kind of always are also coming along, not as strong. Bonds were up a little bit because the yields went down a little bit. We saw inflation start to moderate. We'll talk more about that in the update, which is probably why commodities didn't do as well, but commodities have done pretty well year to date, but still a strong performance even for the month. So let's get into the market update. All right, first let's start with the main reason we had stagflation in the 70s. Now, first of all, stagflation, again, is the stag part is a stagnant economy, and the flation part, of course, is inflation. And so what happened in the 70s is we had that combination, that horrible combination, and so now we're a little concerned, is it happening again? And so what caused all that big inflation back in the 70s? Well, number one, there was some food inflation, a lot of food inflation. And a lot of what happened there was some really bad weather events. There were some disease that occurred right at the beginning of the 70s, right before all the craziness, which is the second part of what caused the inflation, which is the big war with Israel and all the Arab countries that created this massive oil embargo, which made oil prices go way up. If you're a little older and you're watching this video, you probably remember getting in those long lines waiting to get your gas because there was an embargo of selling the oil to the U.S. And so it made the prices go up dramatically here in the U.S. That created a big supply shock that created a lot of inflation here. And then the last part too, it's the government got involved. They actually tried to control the prices of things and wages back in the 70s, and they just realized it wasn't working, and then they just let it go. And then that, of course, once they let it go, prices went up, wages went up, and it created this triple effect of horrible inflation that actually did finally create a recession, and it kind of went through two cycles. So it happened, two different situations that were similar, both in the 70s, which is why we saw all that inflation and a recession. All right, so let's get into the actual numbers that we've seen so far for the 2020 decade, compare it to the 70s. All right, now I know it's not fair to just look at the first 4 years. We got a long way to go, and you can argue that things may change, of course. But for right now, the 70s looks to have had much worse inflation than we've had so far in the 2020s. So in the 70s, we had inflation as high as 14%. Now, it was a range of 14 to 5.5, and it ended up being almost 7% on average during the 70s, which is pretty painful if you think about how much your money's got to grow and how much more wages you have to earn just to pay for things. In the 2020s, Started off okay, but with the pandemic and things afterwards, we've really hit a lot of inflation, and it's caused a lot of trouble for all Americans. So we've had an average inflation rate of about 4.5%, where it got up as high as 8, and it started off around 1.23 or so. So the inflation has been a lot worse than average, which is somewhere in the 2 to 3% range, but it hasn't been quite as bad as it was in the 70s. And of course, we haven't had an official recession like they had in the 70s yet. So of course, that's something that can change, but for now, it still looks like the economy is holding up. All right, so to answer the question, are we going to have another repeat of what we saw in the 70s? You have to understand the law of supply and demand. All right, so what happened during the pandemic is we were buying lots of stuff. Demand went up. We couldn't go anywhere, right? And all the factories were shut down because of the lockdowns. That made prices go up. Now, that wasn't the only reason prices went up, but that was a big reason. And so to get the prices to go down, we have to reduce demand or increase supply. Now, we've been starting to increase supply, and demand has come down a little bit, so that's why you're starting to see the prices stabilize here a little bit. Back in the 70s, something broke, okay? Supply did not go up of oil. That was the big thing that caused the inflation. A lot of the inflation was induced because of that oil shock, that embargo, that big war that we had with the Arab states, and then later with Iran. And so what you're seeing here is that prices didn't fall. And that is not normal, because when you have a slowdown, when you have a recession, that creates less demand, which makes prices fall. But when there's a shock, a supply shock like in the 70s, that's when things break and you get that sticky price and a slowdown on top of that. And then the last thing I would add to this story, which is also very important to understand, is that we are in a very different economy than we were back in the 70s. And so there's two things. A supply shock is less likely to happen today, okay? And I'll show you why. And it also will probably have a much smaller impact. So let's take a look at that real quick. Well, first of all, you can see that we have much more oil diversification than we did back in the 70s. In fact, you can see here the U.S. is actually the largest producer of oil in the world, okay? And this was not the case in the 70s. I'll flash another one that you can see how over time our production of oil has gone up, and all these other countries like Canada, Norway, all these other countries have been building up a lot more production of oil over time versus Saudi Arabia and the Middle Eastern states. And then the last thing is we are just less oil dependent than we were back in the 70s. As you can see from this chart, this is how much oil it took per unit of GDP back in the 70s. And you can see as we go through time, we've become less and less dependent. Less than half of what we were back in the 70s to produce the same amount of GDP. So it's not going to have the same impact, even if we do have some supply shocks, which could happen still. They just wouldn't be as severe, and it wouldn't have as much of an impact. Oh yeah, one more thing. It's actually several more things, but this I thought was a big one too. We now have strategic reserves. Before the 70s, big importing countries didn't do this, and after the 70s they learned their lesson. So the US has the biggest strategic reserves, but actually there's a lot of other countries that do the same that are big importers, and that is there to cushion supply shocks. All right, so let's get into the market outlook. So the big question is, are we going to have a growth scare, or are we still really in the Goldilocks situation here? Because a growth scare, I would say, is not really priced into the market. We could see the market take a dip. But if we're in Goldilocks, we could continue on this nice little path of gaining in the market. Let's take a look. All right, the first of the big economic news that came out for the month of May was GDP for the first quarter came revised. It was 1.5. It went down a little bit to 1.3. So I would say that this is neutral. I wouldn't say that it is bad because we're still growing, but it wasn't as strong as we thought. And now we're also seeing the Q2 numbers start to come down a little bit as well. So we're neutral here. All right, now the next big economic report was the ISM manufacturing PMI and the ISM services PMI. And the manufacturing was basically weak. I would call that one kind of bad. Anything under 50 means that we're in a slowdown. But then the services was actually pretty strong. It came up way above 50 at 53.8. So I would say that that one actually looks really strong. So again, you put the two together and we're kind of neutral. All right, of course we got the Fed. Right now, the Fed looks like it's going to be cutting. There's a 50% chance in September, so that's actually pretty good because that means that we could get multiple cuts still by the end of the year. And then we also had the recent unemployment report that came out just on Friday that showed that the economy still looks pretty good. We had 272,000 jobs added in May, which was a pickup of 175 in April. Now, generally, the trend has been going down, so I would say that that's good to neutral, but overall, pretty neutral. And then the last thing I would leave you with here is the earnings estimates have been going up for the second quarter by 0.3%. Now, that doesn't seem like a lot, but earnings estimates usually go down as the quarters go by. And so the fact that they're actually showing earnings estimates go up is actually a pretty positive thing. And we also had the core PCE. Again, remember, that is the Fed's favorite inflation number. And they looked at that, and in May, it actually went up 0.2 versus 0.3 the previous month. And now we're at 2.8, which is actually the same as last year. But I would say that that is probably neutral, but it's kind of on the good side. So I would say the earnings estimate's positive and the PCE is neutral. So overall, you can see how we're probably in a Goldilocks. It's not too hot, not too cold. Everything looks pretty good. You want that because if it was too hot, inflation would come back. If it was too cold, we'd have a recession. So we're kind of right in that little sweet spot where it's looking pretty good. All right, so what does that mean for the Heartwood implications? Goldilocks means things are still looking pretty good for the economy and for the stock market. So I'm going to give this a slightly bullish tilt. Which is why you're seeing this in the green. We're slightly adding a little bit more to stocks, still focusing more on the large cap, starting to look more at the value that have been beaten up a little bit more and haven't run up as much as the large cap tack. Adding a little bit to international. I think there's some hope there as they start to cut rates and their economies have been holding up. And really just trimming back from the bonds and the cash a little bit to make up in the areas in the stocks. All right. So I hope this all makes sense. If you have any questions, please feel free to give me a ring, send me an email. And thank you very much for watching, and God bless.